بسم الله الرحمن الرحيم. الحمد لله والصلاة والسلام على نبينا محمد وعلى آله وصحبه أجمعين. السلام عليكم ورحمة الله وبركاته. Welcome to chapter 21. The topic is about mergers and acquisitions and corporate control. Let's start here in the first slide. We just have a graph of the historical number of mergers in the United States. So this graph shows us the number of mergers in the United States over the period 1962 to 2009. So you can see from the graph there was a huge increase in number of mergers over the period 1962 to 1974. Then after that there was a reductions. Then again another spike or increase in the period in 1995 to 2009. In general, we can say there is an increased trend, because if you just put a line from 1962 to 2009, this is an increased trend over the period. Now let's talk about types of mergers. Here we have three types. First of all, when we say merge, what we mean by merge? In general, a merge is happening when two or more companies combine to form one, like a new company. So if we have two companies and those two companies they combine together to form only one company, we call it merge. Now there is many different types of merge, actually three types: a horizontal merger, vertical merger, and conglomerate merger. Horizontal merger is a merger between two firms in the same line of business. They are working in the same business or the same type. Like for example, if Coca-Cola merge with Pepsi, this one we call it horizontal merger, because they are working in the same industry. They almost have the same product. They are competitors, right? So the competitor can merge together. Another example, if Adidas and Nike merge together, we call it horizontal merger. They have the same type of business. The second one called vertical merger. This is a merger between companies at different stage of productions. Example, if Apple company merge with one of their suppliers, like one of the firm that supplies any materials of like for the mobile, this is we call it vertical merge. So here we have a big company merge with another small company which is a supplier for the company, okay, for the big one. This is an example. Another example, if Coca-Cola merge with another company that produced the cans for the Coca-Cola, this we call it vertical merger. So basically it's two companies but they are working in different stage of productions, like big company and the supplier, or big company and the distributors. So let's say you are selling tables, right? But you need a company that distributes the tables to the customers. You can merge it with the distributor company. Okay, this we call it vertical, like from the name vertical, like one small company to the bigger company. Then we have conglomerate merge or merger. It is a merger between companies in unrelated lines of business. If two companies they are in two different business, two different industry, they merge together, we call it a conglomerate. Example, if Coca-Cola merged with Adidas, this one we call it a conglomerate merger, because they are in two different industry. Now let's talk about the sensible reasons for mergers. Why companies merge together? There are four main reasons, okay? The first one, economic of scale, then economic of vertical integrations, then combining complementary resources, and mergers as a use for surplus funds. I explain each of them in the next few slides, inshallah. Let's start with this one, economics of scale. With economics of scale, a larger firm may be able to reduce its per unit cost. When two companies merge together, this will reduce the cost. How? This can be done through the sharing of resources and technology and eliminations of needless duplications and waste. So when two companies combine together, this will reduce the cost for production cost of producing products. Why? Because those companies, when we merge it and we form one company, then we share the resources, we share the technology, okay, and this will reduce our cost. And this is actually true, like when the company became bigger, they can produce at lower cost. Next one, economics of vertical integrations. The merge will give you control over suppliers, and this may reduce the cost, right? When two companies combine, okay, for example, a big company with the supplier, definitely this will reduce the cost because you will buy them raw materials at a lower price instead of buying the suppliers or the raw materials from an outside company. You will buy it from your own company, okay, because you merge together. But here we need to be careful. Our integrations can causes the opposite effect. Okay, so like if you combine with the other companies that you don't need, this will increase your cost because there will be too much duplications. There will be many employees coming from the new company. You don't need them. So here we have a graph just to show you pre-integrations that I highlighted in yellow color. Okay, the company was less efficient. They were using here actually many suppliers like supplier 1, 2, 3, 4, okay, and each of them will charge you a different price. Okay, so price is high here for raw materials for the company, but both integrations that I highlighted in pink, if you buy one of the supplier, then you will be more efficient and your supplies and raw materials will be only from one company, which is basically your company, your branch, and you will buy it at the cost at a lower cost. The third reason, combining complementary resources. Merging may result in each firm filling in the missing pieces of their firm with the pieces from other firm. For example, from A and B, they can merge together. Like if we combine a firm that is very good at distributions with another marketing firm, and this will give you a very efficient company. Example, a small firm may have a valuable patent, but like the engineering and sales recognize necessary to reduce and make it on the larger scales. It could be acquired by a larger firm with those capacity already in place. And this is a nice example. Imagine a company that has patent for a new innovations. So here a small firm, they have patent, but actually they cannot produce the product because they don't have enough engineering or enough machines or enough factories to convert this patent into a final product. So they can merge with another company that already have those capacity and those resources, and this will work well for both companies. The last one, used for surplus fund. If your firm is a matured industry with a few positive MPV projects available, then acquisitions may be the best use of your fund. So if you are in an industry and you don't have too much positive MPV project like good projects, you don't have too much of a projects to invest. Now one way to use your money if there is no project to invest, you can acquire another firm, and this will be the best use of your fund, because when you acquire or you merge with another firm, this will give you some advantage that we just talk about. Okay, plus if you merge with another competitor, it means you are removing that competitor from the market because you bought them. Okay, so you will be the only one in the market. Now what might this imply about the pre and post acquisitions present value growth opportunity? Definitely after the acquisitions there will be positive present value growth opportunity because we will have positive outcome from the merge. Now let's talk about dubious reasons for mergers. Two reasons. One, diversifications, and the other one, the bootstrap game. Dubious means questionable or doubtful. First of all, diversifications. So What's the idea here? Investors should not pay premium or diversification since they can do it themselves. In many cases, shareholders can easily diversify their risk through investment portfolio, while a merger of two companies is typically a long and risky transition. So, what's the idea here? When two companies combine with each other, let's say we have company A and this company decide to merge with another company, let's call it company B. Normally, when company A acquire a company B, they need to pay for them the premium. They need to pay high amount of money in order to take the company. Example, Facebook and WhatsApp. Facebook in 2014 paid $19 billion for WhatsApp to buy them. If you think of this transitions, it is very huge. WhatsApp is just an application and maximum it may worth 100 million, but they paid for them 19 billion. So they paid a premium. Okay, in this case, this is from the money of whom? This is from the money of the investor who invests in Facebook. So this is one of the questionable reasons the company may say, I want to diversify, I want to acquire another company, but for me as an visitor, I can't do it by myself. No need to pay too much money for the other company to acquire. I can simply invest in many stocks instead of one company. So the reason for diversification is suspicious because the investor themselves should not pay any premium for diversifications. They can do it by themselves. Okay, so if I am an investor investing, for example, in Al Hospital, okay, if Al want to acquire another hospital and pay a large amount of money, I might be not supporting for that transitions. Why? Because I can easily diversify by investing in many companies. Okay, I can invest in Al here and other hospitals. Okay, why would I pay too much money for another hospital to be acquired by my hospital? Then we have bootstrap game. Okay, acquiring firm. So basically the idea here, normally they acquire a firm that has a high PE ratio, P price E earning. So they acquire a firm that has high PE ratio and selling firm that has low PE ratio. After the merge, the acquiring firm will has shorter EPS, earning per share rise. On the long term, the acquirer will have slower than the normal earning per share growth due to share dilution. So basically the idea, normally companies or acquiring firm, they has a higher PE ratio. They sell firms that have low PE ratio, and this results in a rise in earning per share over the short term. But on the long term, we will have a slower than normal earning per share growth. This is an example, is the same idea of the previous slide. It's easy, you can read it by yourself. Now let's talk about the goal of the acquisitions. For merger, when the acquiring firm buys all the assets and all the liabilities of the other firm and combine them into one firm, we call it merge. Okay, again, when one company buy all assets and all liabilities of the other firm and combine them into one firm, this is, we call it what? We call it merger. Okay. Tender offer is another type, but here the acquiring firm buys all the stocks of the target firm, not assets. They buy all the stocks of the target firm. Okay. The third one called assets purchase. So when the acquiring firm or the big firm buys only the assets of the target firm, the target continues to exist, okay, as a firm with the cash instead of assets. This is, we call it assets purchase. So think on it as three different products or three different types. Sometimes we have a merge, so one company will buy all assets and liability of another company. Then another type called only tender offer, they will buy only stocks. Another type, you will buy only target. Okay, so you need to know the definition of each of them. Evaluating mergers. Now, when we evaluate whether the merge is successful or not, you need to ask yourself two questions. The first one, Is there an overall economic gain to the merger or not? Um, do the terms of the merger make the company and its shareholders better off or not? Basically, we want to know if the present value of A plus B, the part that I highlighted in equal color, is more than the part that I highlighted in pink color, present value of A plus present value of B or not. Let me explain this one. Assume A is the big company, okay, major company, and B is a target company, the small company. Before merge, there will be two different companies, right? One called A and one called B. Let's put a number, okay? Assume here we have one large firm A and a small firm is B. The large firm, let's say the value is 100 million, the value of A, okay, company A. The value of B, the small company, is 50 million. Now, after merge, when we put them together, okay, A plus B in the bar that I highlighted in equal color, if the value here after merge is more than the individual value or the separate value that part I highlighted in pink color, then we call this one successful, okay? So when you add them together, sometimes the value of the new company here in part that I highlighted in equal color, after we add them together, will be much higher than the individual sum of each company, okay? So here we said 100 plus 50, but sometime, actually most of the time, when you merge them together, when the two companies merge, the value here in the bar that I highlighted in equal color will be much higher than the individual one that I highlighted in pink color. So it could be here 200 million like together, or 300 or 400 million or whatever, because they complete each other, okay? Now this is, we call it what? Synergy. So this synergy occurs when two firms are worth more together than when apart, okay? So if two firms worth more, when we put them together, we call it synergy. Example, as I said, Facebook and WhatsApp, okay? Separately, the value was lower. I cannot remember what the value. When you add them together now, Facebook and WhatsApp became bigger and the value is higher for sure. So the idea here is that if we have two company in the market, if one company, let's call it A, worth 100 million, and the other company, let's call it B, worth 50, okay, million. Now, if you want to add them together, they were worth all together 150, right? 100 plus 50. But actually, these two companies, if they united and became one company, the value of the new company will be more than 150, right? It will become 203 or 400, okay, or whatever, for many reasons. One of them, that you don't have a new competitor in the market. Before the merging, they was two company against each other in the market, but after merge you become one big company, has a control in the market and the prices without competitor, and you control many things, okay? So the value of the company will be higher. This we call it synergy, okay? So synergy occur when the value of two firms are more than the individual values. Now let's talk about financing mergers. How to finance, from where we get the money. Merger financed by cash, could be by cash, or financed by stock, right? So you can pay cash, like one company buy another company and paid everything cash for the company. So what does this mean? This means a big company, let's say the big company will buy like all the stocks from the small company. So the shareholder of the small company will receive the money cash in their bank account. This is one way. Another way is to give the shareholder of the small companies, to give them stocks in the new company. Now we have company A, which is a big one, company B, the small one. We will merge it together. Now the new company, let's call it C. Because we merge them together, we can give the shareholder of the small company stock in the new company, okay? So we say to them, we don't have money, but you will own stocks in the new company, okay? This is one way to pay for merge. Now, evaluating mergers, basically we want to know whether there is an economic gain from the merge or not. And this economic gain is equal to what? It's equal to the present value of increased earnings. So in two companies combined together, this will increase their earning, but we will calculate the present value of the increased earning. And this is equal to what? This is equal to new cash flow from synergy divided by the discount rate. Basically, the new cash flow, when the two companies combine together, they may have a higher cash flow, right? This new cash flow, you discount it in the discount rate, and this will give you the present value. We have examples given a 20% cost of funds. What is the economic gain? So the question is clear. What is the economic gain? If any of the merger listed below, we have two companies here. The first company called Gen Farm and the other one Biotics. So let's have a look of the table here. What we have. The first column here we have for Gen Farm. The second one for Biotics. So let's have a look of the table here. What we have. The first column here we have a Gen Farm. The second one for Biotics. Then the third one is when we combine them together. Okay. Now the line that I highlighted in pink color, okay, the revenue for the first company was 200 million before merge. For Biotics was 25 million before merge. When we merge them together, the result in 225 million. Okay. Okay. In the line that I highlighted in yellow color for operating costs for the first firm, 110. The second one, 17. When we merge them together, this result is an operating cost 120. So actually, if you want to add 10 plus 17, this will be 1 of 27. But here, because they merge together, okay, they merge together, they have some benefit. This is we call it synergies. Okay, so the total cost is not 127. It is 120. So the two companies, when they merged, they actually were able to reduce their cost, to cut the cost. Now we care about earning, the line that I highlighted in orange. And we know to calculate earnings, it always equal revenue minus operating cost, right? So here in the pink revenue, we have 200 million minus 110 in yellow operating cost. The answer is 90, okay, in orange earnings. For Biotics, same things, 25 minus 17, it's 8. Okay, for the combined or the new company, which we are interested in, okay, 222 minus 120, this is 105. Now let's add another column that I highlighted in gray color, okay, which is the difference between the individual one and the combined one. So 200 plus 25, this will be 225, and the combined is 225, which means we have 0 plus, no synergy here. Okay, so the combined company has the same revenue as the individual companies. However, for the cost, if you add 110 and 17, this will be 127, but the combined is 120, so the difference here is minus 7. As I said, the companies or the new company were able to reduce cost by 7 million. So this is actually our gain. Okay, we have 7 million less in cost, which means our cash flow increased by 7 million because we saved those costs. So economic gain based on the previous formula, it's equal 7 divided by 0.20. 20 is given here, the discount rate, and the answer is $35. There is a question in the slide: which of the sensible reasons for a merger is this merger most likely based on? So based on the informations here, okay, what do you think? Why those companies they merge? For which reasons, or what was the benefit? The main benefit was economic of scale, As I said before, when two companies combine together, they will be very big and they can reduce the cost of productions. And this is what we have seen here. Okay, there was no increase in the revenue, but the new company saved 7 million in cost. So here the reasons or the main benefit is economic of scales that leads to reductions in operating cost. Okay, now we will move to the market for corporate control, or we will talk about the role of equity markets in facilitating corporate takeovers. We have here four different types. One called proxy contests, the second one called takeovers, then we have leverage buyout, then we have divestitures, spin-offs, or carve-out. Proxy contest. When we say a proxy, it means the right to fight for another shareholder's shares. Proxy contest means a takeover attempt in which outsiders company or outsiders compete with management for shareholders' votes. This is we call it proxy contest. So here we are talking about how one company can acquire another company. There is many different ways. Okay, one way is called proxy contest. So the idea here, there will be a takeover or a merge. Takeover means one company will take another company. Okay. So here we have a takeover attempt in which the outsiders or the new company or a big company will compete with the management for shareholder votes. So they will try to get the shareholders vote, okay, in order to buy the new company. Dissident shareholders attempt to gain enough proxies to elect their own slate of directors. So they will have more votes and the proxies in order to change the board of directors. Then the board of directors will accept the merger with another company. So this is in case the management they don't want to merge. The new company will go to the shareholders. In 2010 there was proxy access. Don't worry about this one because the rule was rejected by the Federal Appeals Court in July 2011. So don't care about this one. Okay, another way to acquire another company called tender offer. This is a direct offer of purchase to current shareholders without consulting with the management. So if a company A want to acquire company B, company A will go directly to shareholders of company B and try to convince them to sell their shares to the company without consulting with the manager or management of the small company. How can management react to a tender off? Now, if they want to stop this tender offer because the management they don't like it, basically when one company take another company, definitely they are going to kick off or fire all the management in the small company, right? That's why in most of the cases the management will be against the acquisitions. I mean the management of the small company. So the management of the small company can react by stock repurchase. So if they have enough money, the management will buy their own stocks from the market in order to stop the new merge. Now let's talk about takeover defense tactic, right? Takeover when a new company wants to acquire a small company or another company. So the idea here, the management of the small company, they can put some tactics or some strategies to stop the takeover. The first one called White Knight. White Knight is a hostile takeover defense whereby a friendly company purchases the target company instead of the unfriendly bidder. The current management typically remains in place in a White Knight scenario. So what's the idea? If company A want to acquire a company B and the management is not happy, they don't want to merge, company B can go to another friendly company, which is company C, and ask them to take the company instead of company A. Okay, so this is the idea. You have A, okay, B, and you have C. Company A want to acquire B. B is not happy. So what they will going to do, they will talk with another company which is C. Okay, like for example, they are a friendly, okay, they are friends. They will ask company C, the friend, to acquire B, so we will have B plus C together, and by doing this they stop companies A from taking company B, right? So the idea here, the current management will stay in the same company B because they will make agreement with the new company, which is C. You can acquire the company, but we will be in the management. So this is one way to stop the unfriendly bidder, which is A. A is unfriendly, so you will ask friendly company to take you, which is C. Okay, the other one called shark repellent. This is an amendment to a company charter made to forestall takeover attempts. So here they try to change the rule distortions, and they try to change the rules inside the company in order to stop the takeover. The third one called poison's bill. So this measure is taken by a target firm, by a small firm to avoid acquisitions. Like for example, poison's bills allows existing shareholders the right to purchase additional shares at a discount, which is effectively diluting the ownership interest of the new hostile takeover party. So basically here the existing shareholders of the small company will be offered to buy more shares in the company in order to stop the new owner or the new company from taking the company. Remember, when we say acquiring one company, acquired or merge with another company, it's all about number of stocks. If you buy all the stocks, it means you own the company. So here they will try the existing shareholders to buy more shares from the market, okay? So they don't allow too much shares for the hostile party or the new company, and this will raise the cost of the acquisitions. So if you want to acquire the company, you need to buy all the shares again, and this will cost money. The third approach is leverage buyouts ratio. So until now we talked about proxy contests, we cover takeover. Now we have something called leverage buyouts or LBO. This is acquisitions of the firm by a private group using substantial borrowed funds. So large portions of payout financed by debt and shares of Libo no longer traded on the open market. So basically here, this acquisitions, you ask a private group, a private investors to buy the company. Okay, so the company now will convert from a public company to private company. Now to buy this company, normally they use debt, okay, large amount of debt. That's why they call it a leverage buyout. So this is one way to acquire the company, is to ask a private investor to buy the company. And here we have actually we need to distinguish between two things, something called leverage buyout and something called management buyout. Leverage buyout, we said it here, it is an acquisition of the firm by a private group using too much debt. Management buyout, it is an acquisition of the firm by its own management in a leverage buyout. Okay, so sometimes the management itself, the management of the company, if they feel the company is good and they want to avoid the merge with another company, the management, the CEOs and all the management can buy the company. So they will buy the company using a large amount of debt. Okay, this is, we call it leverage buyout. Now let's talk about potential gains from an LBO. Junk bond market. So in a leverage buyout, there is usually a ratio of 19% debt to 10% equity. So when we say leverage buyout transitions, it means most of the money was from debt, 90% debt, like for example 10% equity because of this high debt to equity ratio. The bond issued in the buyout are usually not investment grade and are referred to as a junk bond. So when one company acquires another company using leverage buyout, this will create something called junk bond market because we are using too much debt. Okay, this transitions will be a junk bond. As there are actually some taxes from leverage buyout because you are using too much debt, and this will reduce your tax because the interest rate on debt is tax deductible. Okay, other shareholders will be happy. Leverage, and there is sometimes some incentives for leverage, and you will have free cash flow. Now let's talk about the last three types. So we covered now leverage buyout. There is something called divestitures. There is a spin-offs and carve out. For the divestitures, when a firm sells some of the assets to another entity as a going concern, this is we call it divestitures. Okay. So what the idea here? The company can sell some division, one of the division of the company, or sell some assets to another company. Okay. Why? Because the company can eliminate redundancy. Okay, they can improve operational efficiency and reduce cost. So like for example, if you are a big company, you have many divisions, and one of the division is not related to your work, actually to your operating, you can sell it to another company. Then we have a spin-off. Spin-off is a process of a business separating the ongoing operating of a unit of the business and giving the shareholders of the parent firm share of the unit. By the way, they are all same, like similar to each other. Just think on it as a different product. Okay, divestitures, you will get rid of one unit. Okay, spin off, the same, you will get rid of one unit, but you will give the shareholder of the parent firm. The shareholder still will have some shares in the new unit even after you sell it. Okay, carve outs, it is similar to spin off, but issues shares of the new firm to the public. Sell it for a new public. Okay, not for the existing. Okay, so here you are selling the shares for the new public, for a new shareholders. Now, benefits and cost of mergers. Who usually benefit from the mergers? We have shareholders of the target company, shareholders of the small company. We receive more money. Normally they receive higher than the price in the market. Like for example, if the share price is $10, when a new company wants to acquire that company, they offer them for example $15 or $14 just to force them to sell the stocks. So the shareholders of the target or the small firm will be benefited from the merge. Okay, definitely lawyers and brokers, they will charge some fees, and the exclusive of the acquiring firm will receive also some salary or some incentives. Okay, now who usually lose in a merger? Shareholders of the acquired due to the overpayment. So the shareholders of the big company sometimes lose because they pay a large amount of a small company. Executives as at a target firm, the executive at the small firm, because most likely they will be fired, right? When the big company acquired the target firm, they will change all the management and executive and many employee. Okay, as I said, will lose their job due to the restrictions. Okay, so this is all for this chapter. Thank you so much, and if you have any point that you don't understand it in this lectures or any lectures in this unit, please feel free to post all your questions and all your concerns in the discussion board in the blackboard, and we'll be more than happy to answer it inshallah. Okay, assalamu alaikum wa rahmatullah wa barakatuh.